welcome to our first webinar in a series that Stearns Financial Group is planned to record discussing private markets. We appreciate you taking the time to join us today and hope you find today's discussion informative. My name is PJ Williams, and I'm the Co-Chief Investment Officer and Director of Investment Operations here at SFG. We're fortunate to be joined today by Phil Bauer. Phil is a Senior Vice President and Portfolio Specialist at Calamos Investments, a global investment firm with close to $50 billion in assets under management across both public and private markets. So thank you, Phil, for joining us today.
Yeah, thanks, PJ, for having me.
Our first webinar in this series is going to focus on private credit, an asset class that SFG believes has a place in many client portfolios despite the asset class experiencing negative headlines in recent months. We're going to first address what private credit is and then discuss the current state of private credit, including the reasons for the negative headlines and the outlook going forward. Before we start, we wanted to let our audience know that some SFG clients may hold investments in Calamos funds. The discussion today is going to focus on the private credit asset class, not any specific fund. With that intro, let's get started, Phil. At a high level, what is private credit, and why has the size of the asset class grown so much in recent years?
For sure. And those are two very topical questions today. Taking the first one, what is private credit? Because a lot of people use the definition differently, and it means a lot of different things to people because the two words don't really mean anything when put together. I think the broadest definition, the way that we tend to think about it is private credit is really just any type of loan that does not include a bank as an intermediary. Okay. And so you are lending directly to a counterparty, to a borrower, whether that be a corporate or against a pool of assets, but there's no bank involvement, whether that be a commercial bank or an investment bank. And so that is the simplest, broadest definition. It does not just mean lending to a corporation, but it does mean lending on what we call a bilateral basis between a lender and a borrower. And so if you think about, okay, private credit, why, to PJ's point, why are people utilizing it within portfolios? Then we'll get into the growth of the asset class. And so simplistically, there are really three key reasons why people tend to use private credit within an overall portfolio construct. And the three are yield premium, downside protection, and diversification. Okay, so yield premium is pretty obvious. I think this is what drew a lot of people initially to the asset class. These loans tend to yield more than their public credit proxies. And so that is what people have really driven a lot of the more recent growth to the asset class. And we can talk about why that is the case. And then downside protection, for the most part, private credit, it's credit, right? And so you are receiving coupons in a lot of cases. It is contractual in nature, okay? And in a lot of cases, these are senior secured first lien loans. And so if a company defaults, if you are senior in nature, you are the first to get repaid back. And so people think of downside protection as a real benefit to the asset class. And then diversification, right? The underlying collateral, whether it be a company or a pool of assets, tends to be different than just stocks and bonds. And so it tends to move differently than those asset classes. And so pulled together, those are really the three key reasons that people tend to allocate towards private credit within an overall portfolio construct.
And Phil, I think for SFG clients, I think that third one, diversification, is really key for us. Having a different return stream than maybe you might see in public market bonds and stocks. And again, we're going to show in a few slides the correlations. And so that's how the stocks and bonds and private credit move either together or in opposite directions. So how tied they are. And so we'll show that the diversification really is something that private credit offers compared to traditional asset classes.
Yeah, exactly. We'll show the backup data, but you are getting exposure to different areas of the economy. And so there is real fundamental reason as to why the asset class tends to move differently than kind of your traditional stocks and bonds. And then it comes to growth. Like, why are you hearing about private credit constantly now, really over the last 5 to 10 years, and in particular over the last couple? And if I could distill that down into one slide, it's this slide. And so this slide is showing really the evolution of bank lending to the US economy going back to the 1950s. Okay. And so I think something that a lot of people don't fully appreciate is that bank lending actually peaked in the early 70s and has effectively gone in one direction, right? There are some ebbs and flows through time, but this has been a downward movement over a long period of time. Okay. And that's not by accident, that is by regulatory design. And the reason for that is that banks are uniquely risky entities. Your typical bank is levered anywhere between 10 and 15 times. and it's making loans with typically your daily savings account, checking accounts, your deposits, right? And so that is a pretty clear asset liability mismatch. And that's why you've had a series of bank runs through history. And so this is a known entity. This is why regulatory authorities prefer lending to happen outside the banking system. And so that is why you've seen this kind of downward move for a long period of time. The ebbs and flows tend to correlate with regulatory regimes that come into place. Okay. And so lending to the economy can really come from two places. It can come from banks or it can come from investors. And so as banks are starting to pull away from holding that risk, that means that investors are holding that risk. And so investors can hold that risk in really two ways. They can hold it in the public markets, so public credit, right? You have very large in high yield markets, you have very large investment grade corporate markets, but they can also hold it in private credit. Okay. And so that's where you've seen really this trend over the last 10 years of private credit gaining more and more of that market share as banks continue to step away. And so we use this slide as a subset to kind of allow people to visualize how that trend has been moving and why. And so what this is showing, there's a lot going on in this slide, but what this is showing is over the last 10 years, a little bit more than 10 years, when a private equity company, okay, buys a company, what they are doing is they're typically putting about 50 to 70% of the purchase price down in equity. And then they are borrowing the other 30 to 50%. Okay. And so what this is showing is where are they borrowing that money from? Are they borrowing it from the public credit markets or are they borrowing it from the private credit markets? And you can see the trend has been historically, they were for the most part in kind of the mid 2010s, they were using the bank loan market predominantly, so public credit, as the primary funder of that. And you can see how that shift has evolved through time, where now private credit makes up the vast majority of that lending. And so the reason being is that if you are a borrower, or it can be private equity or not, you have two choices. You can go to investment bank to get something that's a little bit more off the shelf. Um, if you're looking for something that is a little bit more traditional in nature, or you can go to the private credit market. And the benefit of doing that, um, and the reason why that line has moved up a little bit, is that you have certainty of execution, right? The lender holds that risk, and so they can tell you what the price is very quickly versus having to wait for investment bank to go to investors to decide what the price is. And then you have definitive execution of that loan, whereas an investment bank doesn't necessarily have to execute on it because they have to wait for investors. And so you've seen this evolution through time where more and more lending has been moving from the public credit markets to the private credit markets, but this does ebb and flow, right? This isn't just going to last forever. This is going to be a market where both of these types of lenders tend to battle for market share.
Phil, with the kind of reduction you showed on the previous slide in bank lending, and now on this slide showing the public markets are lending less and more is moving towards private markets. We know the asset class has grown to, correct me if I'm wrong, but $2 trillion maybe in the private credit world these days. Have we seen a loosening of underwriting standards compared to what you saw first with the banks and then public markets? And should that be a concern for investors?
Yes, 100%. And that's a perfect segue into the next slide, which is showing what the full really opportunity set is within private credit, right? A lot of people think of private credit and they just think of direct lending, which is lending to a corporation, right? A lot of what I showed on the previous slide is direct lending. And so a lot of people equate those two discussions, but private credit is, again, much more than just direct lending. And so this is a really important construct. And when you think about, okay, the growth of the asset class, okay, from I think it was 500 billion probably 10 years ago to now it's over 2 trillion. And if you include all of these areas, probably close to 3.5 trillion. So it has grown quite a bit, but it continues to diversify. And this is as banks continue to really get forced out of a lot of these markets for regulatory purposes. Private credit has continued to step in. And so as you've seen more and more investors invest in the asset class, and you've seen more and more funds grow over the last couple of years, have underwriting standards loosen. And in particular areas of the market, they for sure have, particularly over the last couple of years, where a lot of that is just purely supply demand. You've seen a lot of the largest funds continue to I would say, benefit from the majority of the fundraising. And so a lot of those funds go into the same areas, and those same areas become competitive, and you effectively compete yourself down on price and down on covenant protections. And in a lot of cases, again, like similar to that chart previously, you are competing against the public credit market. And so in a lot of cases, to win those deals, you have to lower the spreads or lower the amount of covenant protections that you are willing to accept. And so in specific areas, you have seen spreads tighten, you have seen covenants get loose. And so that's a huge, huge factor to be aware of. In a lot of cases, that's in specific areas where the fundraising has been.
Got it.
And so if you look at this full slide, right, direct lending is still a large portion of the universe. It makes up just under 50% of the market. But what you're seeing an expansion out into these other areas. And so you have the ability to continue to diversify and grow the opportunity set and grow the ability to put money to work. And even in direct lending means a lot of things. You're lending to a corporation, but it has a lot of different flavors. You can be lending to a small company, to a big company, to a private equity backed company or non-private equity backed company. That's what sponsored and non-sponsored means. You could be lending to the US, to Europe. And so there is quite a bit of differentiation even within direct lending. But as you move to the right towards these other areas, to the point on diversification, you're getting exposure to very different return factors where the underlying collateral is not necessarily how a company is performing or its underlying cash flows. You can be lending against hard assets or real estate or real asset credit, which includes pipelines and airplanes. Some people like to talk about specialty finance because there's some pretty esoteric areas within there, such as music royalties, healthcare royalties, litigation finance. There's a lot of different underlying structures and subsectors within private credit that a lot of people don't fully appreciate because most investors still to this day are predominantly invested in direct lending.
And I don't want to state the obvious here, and we're going to talk about software a little bit later on, which is maybe a different part of this equation. But a lot of this, what you're talking about, there is collateral, tangible collateral in many cases sitting under these loans, backing these loans. And so investors do, in many cases, have protections from those assets that are sitting underneath where they are in the capital structure or just backing the loan directly.
Exactly. And so again, a lot of people equate direct lending to private credit where you're lending against a company and that company may or may not have assets. They might be asset heavy, they might be asset light. And so your recovery value if something goes wrong could be contingent on the value of those assets. As you move to the right here, you can have hard assets. Commercial real estate obviously has hard assets, but a lot of these underlying areas, whether it be equipment leasing or technology lending, you have underlying hard collateral that if something goes wrong, that collateral is yours, whether you want to repurpose it or resell it. And so in a lot of cases, you know what your downside is based on the value of the underlying collateral. For example, we call transportation finance and real asset credit, but people don't fully appreciate in a lot of cases that your typical airline does not own the underlying airplanes they use. They lease them. And so they're leasing them from someone. And so if you are on the other side of that, you own the airplane. And so if an airline doesn't pay the lease or backs out of it for any particular reason, whether they can or they, depending on the structure, you can repurpose that airplane or sell it. There are a lot of use cases that you can have around that collateral as an example. And so in a lot of cases, again, in credit, this is why we talk about downside protection. You have a recovery value. Even if something goes wrong, you're typically not losing 100 cents on the dollar. And just to showcase that in a little bit different way, it's effectively the same slide, but showing, hey, what is the collateral beneath it? And so it just gives you a pretty good view into, even within private credit, the diversification that can be sought when you're allocating across the full exposure of the asset class, because this is how institutional investors look at the space, right? They are allocating broadly across the asset class. They're not just investing purely into one particular risk factor, whether it be direct lending or real estate credit. They're taking a broader view and allocating in a diversified sense across them. And then if you want to be an active manager, you can also take relative value decisions within there. But again, this is credit. Diversification is absolutely paramount because most of your risk is to the downside. And so you need to be as diversified as humanly possible to mitigate any of that idiosyncratic risk. And a way of doing that is getting exposure to different risk factors.
Is it correct to say that the negative headlines, the spotlights have been on funds and fund companies in the last few months really is focused on that left box, the direct lending. But like you're sitting here, there's a world beyond direct lending that has other characteristics that are not just, kind of corporate direct lending that we've seen the news headlines from.
100%. Pretty much all of the headlines have been centered on direct lending because that is what a lot of business development companies or BDCs invest in. But as you think about the space more broadly, you're really not seeing the same level of pressure, the same headlines that you are seeing in direct lending in these other areas. And a lot of that is a function of supply demand. Again, a lot of it comes back to just pure economics because you're seeing banks really coming out of 2023. You're seeing banks get forced out of a lot of these other areas. Um, Kind of post Silicon Valley Bank and First Republic going under, you've had more regulations be put in place that is causing banks to pull back. And the interesting part of these slides are that banks have been, none of them are new. Banks have been the primary lender in pretty much all of these areas at some point. It's just that they are starting to retreat. And so private credit is stepping in to fill that slot and hold that risk themselves. It's just that all of these areas are quite different. And banks, particularly on the ones to the right, are getting forced out of those markets at a more rapid pace because of 2023. And so again, we mentioned the diversification benefit within there, and these are just some of the stats you can see, like relative to corporate credit. We use direct lending here, but direct lending is obviously going to be relatively correlated to high yield, to bank loans, to the S&P. You're talking about corporations, but it's not as correlated to some of those asset-backed finance sectors like real asset credit, real estate credit, and specialty finance, where your underlying collateral is just different than an underlying company's performance. And so being able to slot private credit into a portfolio is helpful, but also being able to get diversified exposure across private credit, we think is instrumental. And so this tends to help showcase that. But at the end of the day, this is why people invest in private credit. I would say particularly more so recently because it's proven itself over a relatively long period of time. And so what I like to do, I think of this as being one of the more important slides to showcase that, because what we have on the right-hand side are gross unlevered returns of just the private credit beta versus the bank loan and the high yield market, the public credit proxies for the space. And you can see over a 20-year period that on an annualized basis, private credit has historically outperformed high yield and bank loans by a pretty wide margin. Again, over a 20-year period, if you compound that, that's pretty dramatic. And so the first question that comes up now is, okay, you've outperformed those asset classes. Are you taking on more risk? What is the offset? There's no free lunch in investing. What are you giving up? And so from a risk perspective, the way that I think most people in credit should think about risk is the risk of losing money, right? The risk of losing capital that has been put to work. And so on the left-hand side, we show historical default and loss rates, again, across the beta of those asset classes. So the indices of those asset classes. And you can see from a default rate perspective, they're pretty similar. They're not too dissimilar, but I view loss rates as the more important metric because even if something defaults, you could still recover 100 cents on the dollar. It doesn't really tell you what your loss is, and you can't paper over losses. You can't. Sometimes there can be technical defaults. People can classify defaults in different ways, but in losses, you either get paid back or you do not. And so you cannot game that type of metric. And so you can see on an annualized basis from a loss rate perspective, that loss rates are also pretty similar. And so what you're giving up is liquidity. And so this is what has been missed in a lot of the more recent headlines is that the reason for the outperformance, the reason that you're getting exposure to this asset class and that it can give you what it's provided is because you are giving up liquidity. There needs to be an understanding that there is a liquidity give up. These are not publicly traded. These are not traded on exchanges. You need to be willing to give up liquidity to benefit from some of the characteristics that private credit can provide.
And so I think on the next slide, we're going to look at spreads. And so again, what a spread is essentially what a borrower is going to pay above a risk-free rate. In many cases, what they're using here, correct me if I'm wrong, Phil, is SOFR, secured overnight financing rate. Again, it replaced LIBOR a few years ago. But again, what you're seeing here, materially higher spreads in a lot of the areas of private credit that Phil's been talking about today compared to the public market, high yield, and bank loans. And so I think a question investors might have is, how do you rectify the material lower spreads for high yield bonds and bank loans compared to direct lending and other areas of private credit when looking at similar default rates, similar loss rates, higher long-term returns for private credit, is it really just the illiquidity premium, or is there something else going on here?
For sure. And so this is probably the most important concept just to understand why am I getting paid? What is causing the spreads to be wider in these private market assets relative to public markets? And this is not always going to be guaranteed, but this historically has been the case. And this is a snapshot of each of those underlying asset classes and what the spread is. To PJ's point, a lot of these are floating rate. And so you can add the 3-month SOFR rate to get the all-in yield. But when you think about from a spread perspective, what is causing this gap? It's really three things. The first is there's a real friction to investing and gaining access and structuring a private loan, right? You cannot just go on your QSIP or you cannot just go on your Bloomberg and type in a QSIP to get exposure to a lot of these underlying loans. The underwriter, the manager has to have relationships in place. They have to have capabilities to structure and originate loans and then have the money to hold that loan on their balance sheet or in their fund. Okay. And so there aren't that many people that can do that, particularly in these areas outside of direct lending. It takes a very specific skill set to be able to do that. And so again, getting back to supply demand, that makes a pretty big difference. You can charge you can charge more for something that there's just less competition, right? And then the other thing that's really important is that you are this whole space, you are disintermediating investment banks for the most part, right? And so you get to keep that investment banking fee, the fee that is charged when it comes to public credit and the issuance and origination of it. That now is kept in for the private credit lender. And then the other part is the liquidity premium that is associated with it. You need to charge the underlying borrower more in a lot of cases for the underlying loan not being liquid, right? There does need to be a liquidity premium. And so those are really the primary reasons around why private credit historically has provided more in spread, more in yield. It's for a lot of those fundamental reasons. But it all gets back to supply demand. Like there's a reason that is the case. And there's a reason direct lending, if we look 2 years ago when the Fed had raised rates very quickly and issuance from the high yield and bank loan markets basically stopped, the spread that a direct lender could command was about 100 basis points, even closer to, in some cases, 200 basis points wider than where they are today because there was just much less competition in that moment. And then over the last 2 years, you've seen a lot of money get raised. You've seen the bank loan market come back online. And so you've seen, to what we were discussing at the very beginning, you've seen more competition for deals, which is why you've seen spreads compress in a lot of cases in the large part of direct lending. So the large cap space, lending to the larger companies. You've also seen covenants get stripped away. And so that competition has created an environment where lending in that particular area of the market is just less attractive than it was, and probably less attractive in a lot of cases than some of these other areas. And so that's how we kind of think about the spread premium. Again, these ebb and flow based on supply demand. And this doesn't tell you what type of underlying covenant you're getting or where in the capital structure you are. But for the most part, over the last 10 years, the public credit markets have been covenant light and have given you less in spread, while as private credit predominantly has been not covenant light and has given you more in spread. But you're starting to see those dynamics start to change, right? You're seeing a lot of cov light, what we call cov light loans in the upper middle market of direct lending. And so being aware of that, we think is really important.
Yep.
And then kind of diving into, I think this is a good slide when it comes to downside protection and how to think about the performance of credit across some of these different asset classes and then compared to equities. And so what we're showing here is quarterly returns and showing the drawdowns for equities, US high yield and private credit. So again, this is just the beta of these markets. And you can see in gray equities, obviously much more volatile, more upside and more downside. And then you compare US high yield bonds to private credit. And in a lot of cases, you're seeing the red line go down further than the blue line. Now, what is causing that? And this is really in our minds like a pretty important piece of like the stability of the asset class from a performance perspective. It's that it's not daily liquid. Again, we keep getting back to the illiquidity of the asset class. As long as you understand that, that can be a real benefit in a lot of cases because what you see in public credit markets and high yield and in bank loans, when something when investors tend to panic, whether it be tariffs or war or a potential recession coming, software, what have you, what happens is investors raise capital. And so they go to sell what they can, and they sell their daily liquid loans or high yield. And that causes this cascading effect where you put in a sell order on a daily basis. The PM then has to raise cash, and they do that by selling a loan, which causes the price to drop in a lot of cases. And you get this almost cascading downward in price, which leads to more redemptions. And so you have these periods of more technical selling pressure volatility. And so the benefit of private credit in a lot of cases, historically, it was pretty much all in drawdown vehicles. So there was basically zero liquidity. Now you have these evergreen funds where you can get out quarterly to a point, but in a lot of cases, you're not a forced seller. And so that tends to be a reason for limiting the drawdown of the asset class. And so that's an important point. It may not be that different fundamentally, but from a price action standpoint, it can be quite different.
Yeah, so like you've seen in the past, investor sentiment's a big player here. Investor sentiment can affect daily traded high yield bonds or equities for that matter, much more so than it affects private market assets that are marked monthly or quarterly, that may be more insulated again from those swings in investor sentiment.
Yeah, 100%. And you're seeing investor sentiment in a lot of these evergreen funds, in a lot of these registered evergreen funds, and we'll get into maybe some of those topics. But again, the structure of those funds limits the amount that can be redeemed. And so in a lot of cases, even if you have a 40 to 50% redemption request, if you only have to fill five of it and you're ready for that for a foreseeable future, and we'll get into some of the mechanics there, like it prevents that forced selling. Like if that PM had to sell 40% of their fund, like that would obviously potentially change the price and lead to more selling. And then you have that cascading down effect. The locked up nature of private credit is in a lot of cases a benefit to investors. Now, it's also really important, I think, to put in perspective because this is missed in a lot of headlines. Like institutional drawdown funds are still 85% plus of the exposure in private credit. And these evergreen, more wealth management oriented registered products make up less than 15%. And so putting that into perspective, I think, is really helpful because the headlines, I don't think, have been doing that justice. And so that is, I still think, an important context to provide to this discussion.
Right. And broadly speaking, if you can speak to with we'll call it a sell-off from these registered vehicles, interval funds, and we're going to talk about them a little bit more in a minute. What is the actual underlying price movement been for the broadly, direct lending market? We haven't seen too much of a sell-off in the actual value of the loans, have we?
No, and you really haven't. I mean, last year, if you look at BDCs, the actual default rate was about 2%, and the actual loss rate was about 70 basis points. And so if you look at that relative to some of the headlines, there does seem to be a bit of a disconnect. And if you get into kind of what is causing that, like how should we think about this looking forward? We do think there are real risks in private credit. It's credit oriented, so you are taking risk to generate those returns. I think the best way of thinking through and distilling, hey, what are the major areas of risk and what should I be mindful of? We like using this slide. There's a lot going on in this slide, but we do think that it helps talk through some of the concepts around where a lot of the risk is being concentrated and a lot of the discussion that's a little bit more nuanced around software specifically, because that is what's leading to a lot of the headlines today. And so what this slide is showing is direct lending oriented. Okay. So a part of the market, but it's showing the amount of issuance per year, per calendar year in direct lending. And then it's showing you in orange what percentage of that was software oriented, right? Software is a pretty major part of the industry because those historically have been very stable, recurring revenue, subscription oriented businesses that now we can have the debate as to how badly that is getting disrupted or not. But if you just look at that over time. And then very importantly, when the Fed stopped raising interest rates in July of 2023. Okay, that's an important metric because these are floating rate loans. And so everything to the left of that line, if it was originated during these periods, then in a lot of cases, those companies or pools of assets, the borrower thought they were going to be borrowing at a 0% rate plus, 6 or 7% type of yields for the duration of their loan. And then you have the Fed raise rates 5.25% in 18 months. And all of a sudden that 7% loan is now 12, 13%. Right. And so you have this situation where you have this vintage where a lot of these loans were not underwritten to the current interest rate regime. And so in our mind, whether it's software or not, that is the biggest risk in the market today. You just have a lot of loans that were done during this period of time that if they have not been refinanced out of portfolios, we view that as the biggest risk, probably the primary correlation as to how something is performing. And then you have the situation where, in 2021 and 2022, you had a lot of the underlying exposure being software oriented. And so if you think about what was going on back then, you were at a time period where you had peak software multiples. There was a lot of competition for those deals. And it was really before the release of any type of AI disruption risk, right? It was before the release of ChatGPT in a lot of cases. And so we think that if you have these loans that were originated to the left of this line that are also software, then they might be under even more stress. And so again, we're talking direct lending specifically, which is where software is going to be oriented. But it is something to keep in mind that if you understand the vintage, understand the exposure, we think outside of those areas, you're not seeing a ton of fundamental decline really at all. And so we do think that's a pretty good way of contextualizing some of the risks in the market today.
But we have seen withdrawals accelerate. And so there is concern. And again, how much of this is just investor sentiment driven versus actual underlying issues? I think you pointed on the slide, a lot of it, there is some software risk. There is some early vintage risk from pre-2023. Those companies had to deal with higher borrowing rates than maybe they were planning for. Obviously, an economic slowdown would be an issue for many corporations. You're lending. If your revenues go down because of an economic recession or slowdown, that's going to affect your ability to repay these loans. But at the same time, there's collateral, there's equity, and many times in these underlying private equity sponsored deals that is also going to be susceptible to that risk before you get to impairing the credit level, the loan level. Is that fair?
100%. Again, remember that the equity has to get worked through before you start to take a dollar of loss in credit. In a lot of cases, these loans are senior, so you are the first to get repaid back. So obviously, a lot of that nuance seems to be getting missed in some of the headlines.
So I think we're to the point. I think the next slide we're getting to gating, which I think is obviously a new word to many people as these evergreen funds, these interval funds have expanded. And so people may not have understood exactly what it meant by having potential quarterly or semi-annual liquidity. And so can you walk us through really how interval funds work at a very high level? And then what does the gating mean? And is gating good or bad for investors in reality?
Yeah, 100%. So this is definitely the topic du jour these days, and we're using this graphic as really a hypothetical way to illustrate so how the mechanics of this actually work. And so an interval fund is a little bit different than a BDC, and so I'll focus more on interval funds, despite BDCs being a little bit more in the headline. So an interval fund for private credit, most of them offer quarterly liquidity up to a 5% cap, right? They have to provide at least 5%. So every quarter, an interval fund must provide at least 5% of liquidity. Um, but you can cap it. And so that is the big difference. Again, getting back to the underlying illiquidity of these assets, like that is a structural reason for why you have these caps in place. You do not want to fire sell these assets because there isn't really an exchange or an efficient way of doing that. And so interval funds are set up so that they are very similar to a mutual fund. They're ticker based. You can subscribe to them daily, but because they're investing in less liquid assets, you have the redemption liquidity be different. And so they're quarterly liquid up to 5%. And so that's what you've been seeing. You've been seeing some interval funds and even BDCs get hit with redemption requests that are above that 5% cap. And so once that happens, the interval fund has the ability to go up to 7% in a lot of cases. But then after that, they do what you call prorating. And so if you have 10% of redemptions and you fulfill 5%, then everyone that asked to redeem got 50% of their money back. And so is that good or bad? It really depends on your perspective in a lot of cases. If you're hoping to get all of your money back and you got 50%, maybe you could think about that as being bad, but there's a reason for that. It is the structural integrity of the underlying portfolio is really, really important. Again, you do not want to have to fire sell these assets. And so limiting the amount of redemptions allows the portfolio manager or the fund manager to set up their portfolio in a way that they can plan for these types of redemption activity to where it is not harmful to the portfolio. And this is why, again, that downside chart, that drawdown chart is just really important. And so when you think about, okay, what are the levers for liquidity within an interval fund on the private credit side, they tend to look something like this in a lot of cases. So because these aren't drawdown funds, right, you are offering what we think of as rebalancing liquidity. A lot of these funds do have liquid assets as a portion of the fund, right? It's not going to be 100% invested in private credit. It's going to be, every fund's going to be a little bit different, but somewhere between 80 and 90% in private credit, and then 10 to 20% in liquid assets that can be more easily sold to provide liquidity. In a lot of cases, the manager will hold cash or raise cash going into a quarterly redemption period. These funds, in a lot of cases, do have leverage facilities, so they can be lightly levered. And then that undrawn leverage can be tapped into to provide liquidity. And then the other part that I would say is relatively missed by headlines these days are that there are natural maturities in this asset class and refinancings. And so if you think about direct lending specifically, the typical loan is 5 to 7 years, and then refinances in a lot of cases about a year before that maturity. And so you have a situation where about 25% on a fully ramped portfolio turns over every year if you're talking about a direct lending specific fund. And so you do have natural cash coming off the portfolio via maturities and refinancings. And so when you put all that together, we think of 1X as being a 5% type of quarterly redemption cap. A lot of these funds do have quite a bit of runway in terms of the amount of quarters that they can actually provide that max liquidity, even if they don't have inflows coming into the fund. And so again, that all gets back to protecting the integrity of the portfolio, not being a forced seller, which again can cause the underlying investors to take it from a price perspective.
I think investors have been spooked by the headlines, not understanding really maybe what they were investing in sometimes with interval funds and what the liquidity offerings really were. And so again, for our clients, that's essential is that, working with your advisor, and the advisor working with the portfolio manager, making sure that your liquidity needs, work with an offering like these interval funds. That is essential, and that's the starting place for this. And so I think many may have not understood fully what they were getting themselves into and how these funds really worked. But beyond gating and beyond concerns about being able to liquidate 100% of your position on a quarterly basis, what do you see for investors as the biggest risk going forward to private credit?
I think the two big risks, I do still think vintage is a pretty big risk as we work through the 2021 vintage. It'll be less so, obviously. And then in a lot of cases, I think it was a lot of funds. We kind of think about it as the factory model took in a lot of flows and had to deploy that. And so you did see, to your point earlier, PJ, you did see, I would say, a lax in terms of protections for some of those investments that took place in 2024 and 2025. And so this reset, we think, is actually pretty healthy because it's going to get us back towards a normalized underwriting environment. And so we think that some of the biggest risks going forward outside of vintage are going to be some of those loans that were done in 2024 and 2025 at pretty high multiples with at pretty compressed spreads in a lot of cases inside 500 basis points. And then again, covenant light. Covenants are your protection mechanisms. They force the underlying equity owner to the table to negotiate with you. You get them to the table earlier if something starts to go wrong, and you can correct course. And so covenants are a really important part of the asset class, and it's why all of the downside, the defaults, losses have been as competitive as they've been. And if you start to get rid of that, then you can start to call into question maybe some of the go forward recovery rates. And so having covenant protections, we think, is really important.
Great. Anything else you want to leave us with regards to private credit? Obviously, I know there's some disclosures probably, but beyond that fun stuff, anything else you'd like to add?
Yeah, we'll leave the disclosures on for a bit for compliance reasons, but I think the big things are understanding the structure, making sure that underlying investors fully appreciate the illiquidity, because that is at the end of the day the benefit, but that becomes a headline when the correct expectations weren't set. And then also fully appreciating that, again, a lot of the headlines are concentrating purely in direct lending and purely in BDCs or direct lending only funds and are missing a lot of the broader construct of private credit is really much more than just lending to corporations. And those other areas of the market are continuing to expand as banks start to pull back. And that is becoming a pretty interesting opportunity. And you saw that in the spreads. That is where we think really over the next 5 to 10 years, that's where the opportunity set in private credit is really moving towards.
Great. Phil, really appreciate your time today. If you're an SFG client, have any questions about this webinar or the private credit exposure in your portfolio, please do not hesitate to reach out to your wealth advisor. Also, be on the lookout for an invite to our next webinar in the private market series. And thank you all again for joining us today.
Thanks, everyone.